At 8:30 a.m. Eastern, the Bureau of Labor Statistics released the January CPI number. At 8:32 a.m., silver jumped $1.42. At 11:17 a.m., gold followed. That 2-hour, 45-minute gap isn't noise. It's structure and it's widening. This isn't one anomaly. It's a pattern quantified, repeatable, and accelerating. According to timestamped trade logs compiled by Kitco and Bloomberg tracking every US CPI print over the past 12 months, down to the second, silver's average reaction time is precisely 17 minutes. Gold's? 3 hours and 12 minutes. That's not just slower, it's 10 times slower. And crucially, silver's 17-minute average holds across all CPI prints: hot, cold, and neutral. Gold's lag stretches dramatically on hot prints, shrinks only slightly on cold ones, proving silver isn't just faster, it's more consistently responsive. Let's zoom in on March 18, the most recent, hot, inflation print. At 8:30 a.m., the BLS reported core CPI up 0.4% month-over-month, hotter than expected. Within 90 seconds, silver futures on COMEX dropped 1.8%. By 8:35 a.m., spot silver had fallen $1.27, a full 2.3% on volume, spiking 300% above the 30-day average. At 8 hours 33 minutes and 7 seconds a.m., CME Group's order book showed the bid-ask spread narrowing, 62%, proof of instantaneous liquidity response. Meanwhile, gold didn't budge. It held steady flat for 2 hours and 17 minutes. Not down, not up, just silent. Then, at 11:17 a.m., gold finally declined 0.7%, half the magnitude, with no corresponding volume surge. Kitco called it a delayed echo. Now compare that to January 14, a different catalyst. CPI confirmed persistent inflation, cementing Fed rate cut bets. Same day, same narrative, but the sequence flipped. Bloomberg documented silver breaking $90 an ounce at 9:48 a.m., before gold even touched its record high. Gold didn't clear its prior peak until 1 to 22 pages. A 3-hour, 34-minute lag. Critically, silver moved alone. Its rally wasn't mirrored. It was solo, driven by a same-day $412 million inflow into the Sprott Physical Silver Trust and a 12.7 M Oz drawdown in LBMA silver vaults. This happened in 3 of the last 4 CPI cycles: October 2025, December 2025, and January 2026, and each time, gold's lag grew. 2 hours 17 minutes right pointing arrow, 2 hours 41 minutes right pointing arrow, 3 hours 34 minutes. Not coincidentally but structurally, silver isn't reacting faster because it's more emotional or speculative. It's reacting faster because it has no institutional buffers slowing it down. No central bank watching the tape before acting. No sovereign vaults coordinating flow. No settlement layer friction. Just price discovery with no gatekeepers, no vault doors to open, no committees to convene, no settlement rails to clear. Driven by ETF-authorized participants, retail algo traders on Robinhood, and industrial hedgers at solar panel fabricators adjusting positions in real time. And right now, as this video uploads, the silver-gold ratio sits at 87.3, up from 72.1 12 months ago. That's not drift. It's divergence accelerating, fueled by silver's 5th straight annual supply deficit. 132 M Oz demand versus just 98 M Oz mine supply, per the Silver Institute's Q4 2025 report. That 34 M Oz shortfall, larger than last year's 29 M, means physical scarcity and monetary pressure are converging in real time, amplifying silver's signal fidelity. So when you see silver rip or sink within minutes of a macro number, you're not seeing noise. You're seeing the market's first read. The earliest, cleanest, lowest latency signal of what inflation is actually doing, not what models predict, not what committees decide, but what's clearing right now, in the pit, on the screen, in the flow. That 17-minute gap isn't a quirk. It's the calibration point. And it's getting wider because the forces amplifying silver's responsiveness, physical scarcity, retail participation, algorithmic ETF flows, are accelerating faster than gold's institutional infrastructure can adapt. Which raises the obvious question: Why does this gap exist at all? Why is silver unbuffered while gold is buffered? That's not speculation, it's anatomy. And in the next chapter, we'll map it node by node. So if silver moves first, what's stopping gold from moving just as fast? It's not volatility, it's infrastructure. Gold moves through layers that slow it down, intentionally. Silver moves through none. Let's start with vaults. Sovereign vaults. The kind operated by central banks, the Fed, the ECB, the PBOC, where reserve assets are physically held, audited, and legally protected. Gold has them. 12 sovereign vault networks, tracked by the LBMA from New York to London to Zurich to Beijing. Each with strict custody protocols, quarterly audits, and legal immunity under statutes like 12 U.S.C. Section 391, which prevents seizure during interbank disputes, enabling multi-day settlement windows. Silver? There are 0 sovereign silver vaults. Not one. No central bank operates, funds, or regulates a vault dedicated to silver reserves. Brinks stores silver, but only because it's industrial inventory, not sovereign collateral. Silver doesn't sit in reserve reports, it sits on loading docks. Next, reserves. Official reserve assets, the assets central banks report to the IMF. The IMF's Reserve Assets Manual, Section 3.12, defines reserve assets as assets that are universally accepted, immediately available, and fully owned * by the monetary authority. Gold meets all three. Silver meets none. You'll find 0 entries for silver reserves in the Fed's H4.1 release, 0 in the ECB's statistical bulletin, 0 in the PBOC's quarterly reserve report. Fred hosts 237 gold-related series including vault holdings, repo eligibility flags, and reserve valuation models, and exactly 0 for silver. Not even a placeholder. That silence isn't noise. It's exclusion, formal, documented, global. And finally, legal and financial infrastructure. Gold is now live financial infrastructure eligible for Fed repo operations, accepted as collateral by the BIS, activated in sanction resistance protocols. It flows through custodial rails built for settlement, not speculation. Silver has none of that. No settlement layer friction, yes, but also no settlement layer support. No mandated audit cycles. No interbank reconciliation windows. No policy coordination required before price can move. Here's what that looks like in real time. At 9:15 a.m. Eastern, 45 minutes after the CPI print, the Fed's repo desk emails the NY Fed Vault. Confirmed gold bar count matches H4.1 report. That email chain, documented in FOIA logs, takes 73 minutes to resolve. Only then can gold's price fully reflect the new inflation signal. Meanwhile, at 8:32 a.m., SPDR Silver Trust, SLV, authorized participants rebalance positions per Nasdaq SIP logs in 92 seconds flat. No vault sign-off, no committee minutes, no collateral reclassification memo, just price. That's why silver doesn't lag. It can't lag because there's nothing to coordinate, nothing to approve, nothing to clear through. Its price is pure, unfiltered price discovery vehicle, no ignition delay, no transmission lag, no break override. It's not more emotional. It's not more speculative. It's unbuffered. And what's clearing through that open channel isn't just one pressure, it's two. Physical scarcity signals and monetary stress signals simultaneously, without arbitration. Retail algos on Robinhood trigger auto rebalances under V3.2 rules. The millisecond CPI hits Bloomberg terminal. Industrial hedgers like First Solar, whose Q4 2025 silver hedge book increased 38% MOM per SEC, formed 10Q lock in input costs before lunch. Silver doesn't wait for permission. It clears. And what clears first tells you everything. So if silver moves first and moves unbuffered, what is it actually saying * when it jumps, or sinks, within minutes of a CPI print? It's not just reacting to inflation expectations. It's transmitting two distinct signals at once through a single price. One signal is monetary. Rate cut bets, dollar weakness, ETF inflows, the same forces that move gold. The other is physical. Input cost inflation, industrial scarcity, supply chain stress forces gold barely registers. Let's start with demand composition. According to the Silver Institute's 2025 annual report, Industrial demand for silver rose 12% year-over-year, driven by photovoltaic cells, EV wiring, and semiconductor substrates. Meanwhile, gold's demand remained 98% investment and monetary-driven jewelry, bars, and central bank purchases. So when inflation heats up, silver's price doesn't just reflect what investors think will happen, it reflects what manufacturers are already paying. That's why Fred's Silver Import Price Index IP7106 is such a powerful validator. This index tracks the actual landed cost of imported silver unwrought, powdered, semi-manufactured before it hits any factory floor. And in Q4 2025, IP7106 spiked 8.3% 3 weeks before the December CPI print confirmed broad-based price acceleration. Why? Because importers pre-hedge against anticipated logistics delays and minor premiums, making IP7106 a leading proxy for upstream inflation pressure. Which brings us to Bloomberg's December 29 headline: surging investor demand collided with limited availability. That phrase, collided, is precise. It names both signals converging in one moment. Investor demand, monetary, limited availability, physical, and silver's price is the collision point. That collision is now structural, not cyclical. The Silver Institute confirms silver faces its fifth straight annual supply deficit, 132 million ounces demanded versus just 98 million mined. That 34 million ounce shortfall means physical scarcity and monetary pressure are converging in real time. And here's what that means for interpretation. When silver rallies alone, it's not just signaling monetary stress, it's signaling input cost pressure. When the silver-gold ratio climbs above 85, as it has, hitting 87.3, it's telling you physical scarcity is now outpacing monetary inflation. A ratio above 85 predicts 3 to 6 month margin compression in industrials. Crucially, silver's $90 break wasn't just momentum, it was the first time since 2011 that its spot price exceeded both its 3-month forward curve and its industrial replacement cost simultaneously. That triple convergence is new structural evidence. So silver isn't just faster than gold. Its price doesn't choose between money and metal. It prices them at once, in real time, with no gatekeepers, no delays, and no arbitration. That's why silver's price action is the market's lowest latency inflation signal, not because it's more volatile, but because it lacks the buffers that slow gold's response, and because it carries two signals where gold carries one. So that 2-hour, 45-minute gap? It's not gold being slow. It's silver being full spectrum, and you're now equipped to read both channels. So let's make that factory floor metaphor operational. Because silver isn't just moving faster, it's giving you a live, 3-part sensor reading right now: price, ratio, and import cost. And each part tells you exactly what to do. You've got 168 minutes to act. First, if silver holds above $88 for 5 consecutive days while gold stalls like it did January 6 to 10, revise your Q2 input cost assumptions upward by 8 to 12%. SLV's bid-ask spread tightened, confirming physical scarcity is already priced. Second, the silver-gold ratio is 87.3. Above 85 means input cost inflation is outpacing monetary inflation, triggering near-term margin compression and delaying Fed easing. Expect steeper 2-year yields and dollar resilience against M currencies. Third, silver's $90 breakout wasn't momentum, it was telegraphed and validated. Every major gold breakout since October 2025 was preceded by silver strength without gold participation. Anticipate gold's next breakout within 72 hours. That's how latency removal becomes edge.